Good morning, doctor and my fellow friends. My name is Tan Pei and my metric number is 278571. Today, our group is going to present the topic Financial Management. What is financial management? Financial management is the planning, arranging, directing, and managing of a company's financial activities such as procurement and use of funds. It entails applying general management ideas to the company's financial resources. The objective of financial management is to secure a consistent and adequate supply of cash to the organization. The next objective is to provide adequate return to shareholders, which will be determined by earning capability, the market price of the stock, and shareholders' expectation. Next, to guarantee the monies are used to their full potential, once funds have been obtained, they should be put to the best possible use at the lowest possible cost. The last objective is to ensure investment safety. Assets should be invested in safety initiative in order to get a sufficient rate of return. So now I will pass to the next person.
Good day to doctor. My name is Pang Lian and my mention number is 280319. After understanding what financial management is, let me explain to you what cash management is. Cash management is the process of collecting and managing the cash flows from operating, investing, and financing activities of a company. In order to keep a company healthy, proper cash management is needed. So, what defines proper cash management? First, there must be a plan for handling excess cash. It does not make sense to keep excess cash on hand because no return will be paid. If the excess cash is used for other purposes, such as purchasing equipment or investing, the company will reap greater returns in the future. In addition to this, a proper cash management involves keeping the operating expenses under control. How to ensure that the operating expenses are under control? An annual audit can be conducted to find out what expenses can be reduced to ensure that all resources are used effectively and efficiently. Don't forget that small changes might add up to make a significant difference. Next, what are the causes of problems with cash management? Undeniably, one of the causes is poor understanding of cash flow cycle. Understanding the timing of cash inflows and outflows from entity enables the management to make better decisions. If this is not the case, the company may run out of money as a result of excessive expenditure and a lack of income. Then, the lack of cash management skills. The company managers must develop cash management skills so that they are able to manage and optimize working capital. For example, establish an appropriate framework to ensure that all receivables are collected on time and payables will not be paid faster than needed. That's all from me. Thank you.
Good day, Dr. Rahimi. My name is Li Shiha, metric number 278841. Now I'm going to present business credit management. Credit management is the process of extending credit to consumers, establishing payment terms and conditions that allow them to pay their bills on time. It is estimated that 1 in 5 business bankruptcies among small to medium companies occurs because customers default on their invoices. So, how could we manage our business credit? First, we must establish client creditworthiness. New clients are a welcome addition to any business, but make sure they do not become a liability. Identify and analyze their risk of defaulting on payments by creating a proactive credit risk mitigation plan. Business owners should also look at customer-specific industry and note the comparison with the economic performance of closely related industries. Besides, keep your terms and conditions clear and consistent. Business owners must outline any or all terms regarding invoice payment to ensure it is made as transparent as possible. This will dramatically decrease the percentage of customers who provide late payment. Bear in mind that a good credit management encourages communication between finance and sales department to achieve a delicate balancing act in which risk is minimized and opportunities are maximized. Thank you.
Good day, doctor. My name is Tan Bonyu, entry number 279218. Today, I am going to share about the importance of credit management. First and foremost, Well credit management could help to protect the company financial stability. With the financial stability, we're able to provide a clear picture to our investor about the stability of our business and also able to create a long-term benefit to our business. Secondly, a good credit management could help us to build a good reputation in the industry, which can be considered trustworthy for investors to invest in our company and also able to attract loyal customers and distinguish our company with our competitors. Thirdly, well credit management could help us to avoid the additional cost of credit, such as penalty, additional interest, or maybe company need to spend more money to cause customer to pay. Fourth, a good credit management could help us to ensure our business have an optimum cash flow. With an optimum cash flow, we're able to convince the new investor to invest our company so that we can generate more profit to our business. And also, with the new investor, we're able to expand our business in the right time. So as during this COVID, the online business have been expanded in this right time with the highest sales. Last but not least, with the well credit management, we're able to build a good relationship with the supplier and customer. For supplier, we're able to reduce the risk of waste and error in the supply chains, and supplier able to provide the quality materials timely. In the other hand, for customers, we're able to maintain the loyalty of our customers and directly increase our sales. That's for me. Thank you.
My name is Jason and I will be explaining what credit control is. Credit control, also known as credit policy, which includes the strategies employed by businesses to accelerate sales of product or services through the extension of credit to potential customer or clients. And there are 4 credit control factors. First factor is the credit period. Credit period is the length of time a customer has to pay. Second factor is the cash discount. Some businesses offer a percentage reduction of discount from the sales price if the purchaser pays in cash before the end of the discount period. Cash discounts present purchasers an incentive to pay in cash more quickly. The third factor is the credit standards. Credit standards include the required financial strength a customer must possess to qualify for credit. Lower credit standards boost sales but also increase bad debts. Many consumer credit applications use a FICO score as a barometer of credit worthiness. Last factor is the credit policy. Credit policy measures the aggressiveness in attempting to collect slow or late paying accounts. A tougher policy may speed up collection but could also anger a customer and drive them to take their business to a competitor.
Good day, Dr. Mat Rahimi. My name is Ting Pei Sing and my metric number is 280306. It's my honor to speak here and I'm very glad to share my topic with you. Today, I would like to talk something about the financial statement. The first financial statement is Statement of Financial Position. It presents the true information about the assets, liabilities, and equities. Besides, it also helps the investor and the other stakeholder for financial analysis as well as track the financial position and make improvement. Next, how to prepare a statement of financial position. It is formatted like the accounting equation, which is asset equals to liabilities plus owner equities. The assets are always listed first and the balance sheet are always in balance. The second financial statement is statement of profit or loss. It shows whether the company performance operations are profitable or loss-making. The management can figure out the problems and then adjust it when the company is losing money. Then, it's also helps to determine how much tax a company needs to pay if it makes a profit. The borrower can understand the financial performance by referring to the statement of profit or loss. Lastly, how to prepare the statement of profit or loss. First, we have to track the revenue and then determine the cost of goods sold. Next, we have to calculate the gross profit and determine the overhead cost to calculate the operating income. Then, we have to adjust for other incomes or expense to determine the net profit. That's all from me. Thank you.